Okay. Hi everyone. So today we are going to study IAS 20, that is Accounting for Government Grants and Disclosure of Government Assistance. Okay. So first thing for us is to understand what is government grant and what is government assistance, right? And then once we understand these two things, then we will see how do we account for government grants and how do we disclose for our government assistance. Okay? So, so government grant is basically transfer of resources to an entity in return for past or future compliance with certain conditions, right? So, for government grant, the definition is transfer of resources to an entity in return for past or future compliance with certain conditions. So, transfer of resources. Who transfers the resources? Government. To whom? To a company, to an entity that's already operating. Why would government transfer resources? Because government wants that you fulfill certain conditions, and if you fulfill certain conditions, we will give you some financial benefit, right? And government assistance is a government action designed to provide an economic benefit to a specific entity, and it is normally not a financial incentive. However, it is a non-financial advice or non-financial incentive in form of advice or policies, etc. Right? So in government grant, and government is actually giving you financial resources. They are giving you money that if you do this, we will give you X amount of money. And government assistance is not in form of money, but it is in form of advice that they're giving to the entities in sort of in form of different policies that they're developing, or they are um, helping the entity in meeting certain regulations. So it is a non-financial incentive, right? So when we talk about IAS 20, 70 to 80% of IAS 20 is about government grants. Why government grants? Because government grants is something that we can value. We can value in financial terms. And something that we can value in financial terms, we have to recognize that in our books, right? And for government assistance, there is no specific or certain financial incentive or financial amount, but there is an non-financial sort of advice, non-financial policies that the government is helping an entity to grow or to contribute to the society. So those sort of things we do not value in our books, but we disclose it in our financial statements that government is, we have got this sort of assistance from the government, and because of this assistance we are meeting certain goals of our company, we are meeting certain financial and non-financial targets of our company, right? So when we are talking about government grants, this thing should be very clear that IAS 20, majority of accounting, majority of discussion in IAS 20 is about government grants, right? Because government assistance we do not recognize in our books, but we disclose it. If we have got any specific assistance from the government has created some sort of policy or they have provided us some sort of advice, then we disclose it in our financial statements, but we don't recognize it as in the valuation form. We don't have a specific amount to recognize in the financial statements. So when we are recognizing government grants, there are two principles that we should be considering, right? One is prudence and the other one is accruals principle. So if you are someone who did your 11th and 12th in commerce, then in 11th standard, we have studied prudence concept. We have studied accruals concept, right? So prudence concept says that until it is not finalized, we are not gonna recognize the income in our books, right? Until it is not finalized, until it is not certain. So in respect of government grants, prudence concept comes as that grants should not be recognized until the conditions of the receipt of the grant have been complied with and there is reasonable assurance that grant will be received, right? Now, prudence concept says that until the conditions of grant are not satisfied, are not met, we should not recognize it. Plus, there should be reasonable assurance that the amount from the government will be received. So, this is what our prudence concept says. Now, you might ask me, what can be the conditions? So, for example, government grants are only given when you comply with certain conditions. Now, for example, you are working, sorry, you have a company that's already operating in a village or in a remote location. Okay, so this is company XYZ. This is operating in a remote location. Remote location. Okay, so government comes to you and government says to company XYZ that if you generate employment and you give employment to the people of remote areas, generate employment and jobs, give jobs to people of remote area, then we will reimburse you or we will give you financial incentive of 20% of their payroll cost. Payroll cost. So this 20% of the payroll cost is my financial incentive. Okay. So for example, you and the government will set target that okay, if you employ, for example, if you give jobs to at least 100 employees, 100 people in the village, in the remote area, then I will reimburse you 20% of the payroll cost. So, for example, now to employ 100 people because you are operating in that remote location, right? Maybe you have some manufacturing facility set up there, you have a plant that's operating, you have a factory that's operating. So, you might need people, right? And if you need 100 people and if you give employment to the people from this location, then government will give you 20% of the payroll cost. Government will reimburse you that. So for example, for 100 people, f- for example, the payroll cost is 100,000, right? Just an example. So government will give you 20% of it. It will reimburse you 20,000. So this 20,000 is my government grant. And now what prudence concept says? Prudence concept says that okay, you can recognize government grant for 20,000, but the conditions of the government grant should be complied with, and there should be reasonable assurance that the grant will be received, right? There should be some sort of assurance that the grant will be received, and this sort of information will be given to you in the case that do you think that there is a reasonable assurance or not? Case will mention it that okay, yes, there is reasonable assurance or is there not. If there is no reasonable assurance, then they will give you hints in the question that okay, they did not receive it last time and it's uncertain if they will receive. So for this condition you will find the solution in the question itself. But for this one, to meet the conditions of the receipt of the grant, you have to evaluate. You have to see that, okay, do you think if I am recognizing grant at my December 31st, 2000X5, if I'm recognizing the grant of 20,000 at this date, do you think at this date I have met this condition? Do you think at this date I have given jobs to 100 people? If you think yes, you have met the criteria, you have given jobs to 100 people, then for sure go ahead and recognize the grant and make sure you consider this as well. If you are not sure, if you have only given um, jobs to maybe 50% of the people, right? So at this point, you have not met all the conditions. At this point, you have not met with the condition of the grant. So you are not eligible yet to recognize the grant in your financial statements, right? So this is what is meant by prudence concept. Okay, and let's move onwards to the accruals concept. Let me just clear this up quickly. Okay, perfect. Okay, sounds good. And now we are going to study about the accruals concept. Like, what does accruals concept say you for the recognition of your grants? So, accrual concept says that the grants should be matched with the expenditure towards which they intended to contribute, right? So this is simple. This is very basic that okay, if you are receiving grant, if you are receiving, okay, for the current example that we saw, that the government says you have to employ 100 people, right? You have to give jobs to 100 employees in your entity. And government says that this 100 people, like the giving employment to 100 people should be uh, given in a time span of like 4 years, for example. In 4 years, the government is saying that you have to give jobs to 100 employees over the time frame of 4 years, right? And if you do that, then I will reimburse you 20% of your payroll cost, right? So now if you have to give 100 employees jobs in 4 years, then each year you will be giving jobs to 25 employees, right? In second year, again 25 employees, and so on, right? So if you have met if you have met the expenditure of 25 employees, if you have met the condition of giving jobs to 25 employees in 1 year, then you can recognize 25% of your grant amount in year one. right? So, for example, again, let's take that example that there was 100,000. I'm thinking that 1 lakh would be my cost for giving jobs to 100 employees, right? And I have to do it for 4 years, right? And then for each year, my government grant would be $25,000, right? If I have met the target of giving jobs to 25 people in year one, then I can recognize this amount. If in year two I have met the condition, then again I will recognize this amount. If in year three I've met the condition, then again I will recognize this amount, right? So I cannot recognize 100,000 in year one if I am doing the expenditure of payroll cost of giving jobs to 100 employees, if that their employee salaries and wages is going to be incurred over the time frame of 4 years, and that is the condition of the grant, right? And if I'm doing it over 4 years, then the grant should also be recognized over 4 years. Okay, so the expenditure should meet the income. Like if the grant you're receiving is your income, so if the expenditure is being incurred in a specific year, then you have to prorate your income and you have to make sure that the income matches the expenditure, right? Okay. Okay, perfect. Let's move ahead. Now, these two are the very basic principles that we will be using, but the IAS 20 is made on these principles. So if you understand these two principles, prudence concept and accruals concept, then understanding the standard will be way easier for you. Okay? So now we have two types of grants. We have two types of grants. First is revenue grant and the other one is capital grant. Okay, so revenue grant. First, we are going to discuss about revenue grant. So, if we have received revenue grant, right? So, in that case, the recognition of revenue grant will depend on following circumstances. First, if the grant is paid when evidence is produced that certain expenditure has been met, then the grant should be matched with that expenditure. Okay. And second, if the grant is paid on a different basis, example, achievement of non-financial objective, the grant should be matched with the identifiable cost of meeting that objective. Okay, so revenue grant. When I say revenue grant, I am saying that the grant which is meant to give you financial incentive for the expenditure that you're doing on a regular basis. Like, for example, employees, if again, I'm going back to that example again, if you are going to give jobs to 100 employees, then if you give jobs to 100 employees, your expense would be salaries and wages of those 100 employees, right? So that is your expenditure. Expenditure that will go into your P&L, that will go into your income statement, right? So revenue grant is something that helps you to reduce your expense, that helps you to reduce the expense that you're putting into your income statement item, right? So that is my revenue grant. And if there is an evidence that the certain expenditure have been met, so if there is an evidence that I have given jobs to 100 employees, if I've given jobs to 100 employees, right? So then the grant amount should be matched with that expenditure. That's the same, this point is telling the same thing which I just told you a couple of minutes ago, that if I am doing the expenditure of giving jobs to 100 employees over 4 years, then I will not recognize all the grant amount in just year one, but I will recognize it over the 4 years, over year one, year two, year three, year four, as I meet the conditions of the exam, as the expenditure is incurred on that, on meeting that condition. Now, in case when there is a grant that is not provided to you because they want you to do some expenditure, but they want you to meet a non-financial objective, right? Non-financial objective could be, for example, reducing the carbon emissions into the environment, right? So this is like a non-financial objective that's not related to your books, right? So then, if you are incurring the cost to reduce the wastage that you are discharging in the environment, if you're doing some sort of efforts, if you're incurring the cost to reduce that wastage so that you meet the non-financial objective, then whatever cost you have incurred to meet that objective, the grant income should be recognized according to that, right? So now let's come up with the journal entries for this one. So like the journal entries. So whenever you are receiving the grant, right? Whenever you're receiving the grant, you'll debit your, if it's already received, right? If you've already received your grant, you'll debit your cash. Okay, and now what should I credit? So in this case, I have like two options. Either I can just credit my expense account. Sorry, not expense account. My government grant income account, right? Or my deferred income account. Deferred income, right? So either if the condition of grants have been met, then I would debit my cash account and I would credit my grant income account. So this income account would go into the credit side of my income statement, right? Because this is my revenue. I have got some sort of expenditure and I am receiving that expenditure, right? So IAS 20 says then when you are receiving a government grant for which you have met certain criteria and you have incurred some sort of expenditure for that government grant, you can either disclose it as an income, like as a separate line item that you have received the grant income, or you can adjust it with your expense amount, right? So, how do you adjust it with your expense account? For example, when you're recording this entry, you will record your entry when your certain expenditure has been met. So, it means you have incurred some sort of expenditure. So, if you're crediting your income on the same hand, what you will be doing? You will be incurring your expense account. So, for example, I am saying that I am debiting my salaries account. Why? Because I'm again talking about that condition that you have to give employment to X number of people in your entity, right? So if you meet that criteria, then your salaries expense account will go up, right? And then your cash account would go down because you're paying the salaries, right? So either you can record this separately, right? You can record as an income separately and you can record an expense separately, or you can adjust it with your expense account, right? Or you can, what you can do is, if your government grant is for 25,000 and this is also for 25,000 and your salaries is for 100,000. So what I can do is I can also adjust my salaries account minus 25,000, 75,000, and I can do my cash by 75,000, right? So in the income statement, if this is your statement of profit and loss, either you can say option one is like grant income would be how much? 25,000 under your revenues, and then under your expenses, you'll have salaries amount of 100,000, right? So this is your option one. Option two is you can recognize your, you will recognize nothing under your revenues or other income, and you can under your expenses, you can basically recognize your salaries expense at 100,000 minus 25,000. So it's one and the same thing, right? It's one and the same thing. Either you recognize it separately or you adjust it with your expense amount. So this is what the standard says when you are recognizing your revenue grants. So the recognition of revenue grant is either present as a credit in statement of profit and loss. That was my option one, or deduct from the related expense. And that's my option two. I hope you are clear with this recognition and presentation of your government grant. Okay, so let's move on to our capital grants now. So this was revenue grants, and now let's move on to capital grants. Okay, so capital grants are the grants that you're receiving not just for the regular expenditure that you're doing, right? It's not related to the salaries expense or your operating expenses or any expenses that would go to your statement of profit and loss, any expenses that would go to your income statement. No. So that is revenue grant. Anything that you think that if you're incurring the expenditure and the nature of that expenditure is to go into the P&L, then that is a revenue grant, right? But for capital grant relates to the purchases of non-current assets, right? So grants received from the government in relation to the purchases of the non-current assets. So non-current assets like PP&E, right? Or your maybe intangible assets, right? So any amount that you are incurring, any expenditure that you're incurring, but that expenditure you're incurring to purchase, to acquire a non-current asset that would not be utilized in one accounting period, but it would be utilized over multiple accounting periods, over number of years. So any grant that is received to meet the condition of purchasing a non-current asset is your capital grant. Okay. So for example, if government says you that currently you have a machinery that is not that efficient and it is going like it is not efficient basically, okay? And if you invest in new machinery which would increase efficiency, increase the quality of the products that you're selling, right? So these sort of factors. If government is saying that if you invest in any machinery, in X sort of machinery, or not just machinery, like any non-current asset, like uh, setting up a factory, setting up a plant at a remote location, or if you want to export goods, so you want to have that sort of infrastructure that you can create to meet that condition, right? So if you're investing in something that would be non-current, right? That would be used more than one accounting year. Like normally it's 1 year, but more than 1 year, right? So if you incur expenditure on the purchase of non-current asset, then that would be considered as your capital grant. So in capital grant, we have two options. Again, similar to our revenue grant, like revenue grant says, oh, you can either recognize grant income and expenses separately, or you can net off your expenses, right? So capital grant also says that grants should be recognized over the useful lives of the related assets. So now why useful lives of the related assets? Now, for example, I have purchased machinery worth 10 million. Okay. I have purchased machinery worth 10 million that will be used in my company for 10 years. And I am receiving 1 million of the grant, right? If I'm investing 10 million, then 1 million I'm getting grant, right? So if I'm incurring expenditure that would generate me benefit for 10 years and I'm getting grant to incur that expenditure. So do you think it would make sense that I would recognize whole 1 million in just 1 year? Or I would go up and I would follow my accruals principle. What does accrual principle says that if expenditure is incurred, you want to match the grant income with the expenditure. So now 10 million is my asset. My asset is 10 million. 10 million would go into the income statement, right? In the form of depreciation over how many years? Over 10 years. So basically, I have invested $10 million, but it will go into my income statement in the form of depreciation over 10 years. Over year 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, right? So it would be used in my business for 10 years. So if I'm receiving a grant to incur the expenditure, then my grant should also meet the expenditure, right? So if my 10 million will be depreciated over 10 years, then my grant should also be recognized in the financial statements over the period of 10 years, right? So how do we recognize that? Okay, so how do we recognize that? So I would say, or not me, but IAS 20 says that there are two options. Okay, there are two options for recognizing your capital grant. What are the two options? Write off grant against the cost of the non-current asset and depreciate the reduced cost. This is option one. Option one. And option two is to treat the grant as a deferred credit and transfer a portion to revenue each year, offsetting the higher depreciation charge on the original cost. Okay, so guys, one thing I want to add here with the revenue grant is that this is the journal entry that I told you that you would recognize when you receive the grant and the conditions have been met, right? However, I just want to add one more thing here, that if the conditions are not met and you received the amount of grant in advance, so what will you do? You will do cash debit for XX amount, and then you will do deferred income credit for excess amount, right? When the conditions met, like for example, this you recognized on May 1st, 2025, you received the money and the conditions are not met, right? But for example, on December 1, 2025, the conditions are met. So what will you do? You will, you would debit your deferred income. You would recognize grant income in your P&L, right? So this should be your credit. So why this? So if the conditions are not met, so you're debiting your cash, that's fine. Why are you debiting your deferred income? Because it is your liability. Liability, why? Because you have received the amount, you have received the grant income when you do not actually meet the conditions. The day when you meet the conditions, when you meet the conditions, then you can reduce your liability and you can increase your income. Here you are receiving money but increasing liability as money has been received in advance, right? Because conditions have not been met. Okay, so this is something that you should keep in mind. Okay, so I don't think so this thing has been added in your Kaplan textbook, but this is how you should be recording it if your conditions are not met and you have received the money in advance. Okay, so coming back to the capital grants now. Okay, so where were we? In the capital grants, we were discussing that capital grants are given if you invest in any non-current assets. So there are two options. One is to write off the cost against the cost of to write off the grant income against the non-current asset. So if I just consider this example which I was discussing here was that I purchased an asset for $10 million and I'm receiving grant of $1 million from the government. So option one would say is that write off the cost grant against the cost of the asset. So what I will do, I will recognize my non-current asset. For example, it's machinery, okay, or PP&E. My PP&E would be debited. How much should be the amount? It should be it should be 10 million minus 1 million. Why? Because I'm netting it off, right? I am reducing the cost through the grant income, right? And then I would credit my cash for the same amount, right? So this is the first option that you net it. If your cost of asset is 10 million and grant income is 1 lakh, 1 million. 1 million is 10 lakhs. So I would do is this minus this. Okay, so it will be 9 million. Out of 10 million, I received grant income of 1 million, then the balance would be 9 million. So this is option one. Now I recorded this on 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 May 1st, 2025. Okay. Now my year end is December 31st, 2025. So now I have to charge depreciation on this, right? So how will I charge depreciation? At year end, I will do depreciation expense debit accumulated depreciation credit for my asset, right? So 9 million divided by how much is the life? 10 years. But guys, I have purchased asset on 1st of May. So how many months? Right? So if this is the yearly depreciation, but this is yearly amount, I have to prorate it now. Prorate depreciation for May to December period. So it will be 8 months, right? So this would be my depreciation expense. Okay, so just to make sure, guys, it should looks good now. Okay, right? So this is the depreciation that I will be charging on my cost of the asset, right? So this is the option one. And now option two. Option two says that you treat the grant as a deferred credit and transfer the portion to revenue each year, offsetting the higher depreciation charge. Okay, so in this case, if I look in my balance sheet, my PP&E cost would be 10 million, oh sorry, 9 million, and my accumulated depreciation would be 600,000. So my net book value in balance sheet would be this much in my statement of financial position. Okay. And in my statement of profit and loss, my depreciation expense would be 600,000, right? This is what should be if we follow option one. Okay, let's do it light. Okay, now option two. Option two states that treat it as a deferred credit. So option two will say that you recognize your asset at the full cost. Full cost means your PPE debit, your cash credit for how much? 10 million cost of the asset, right? And here you're recording purchase of asset. So option 2 says now record the grant separately. So to record government grant received, and this should be on May 1st, 2025. And we are assuming we got the government grant on the same date. So what will I do? I will say cash debit. How much? 1 million. 1 million here. And then I would say, what should I say? Should I credit my income? Should I credit my income account? Or should I credit my deferred income account? So, guys, here you have to be careful. You are receiving the government grant, but the expenditure should meet the income, right? So you cannot record the 1 million of government grant into the current year. So what are you going to do? What are you going to credit? You're going to credit your deferred income for 1 lakh. Okay. So this is your debit and this is your credit. So here you're receiving money. Money goes up and your liability goes up too. Why? Because income from government grant needs to match, needs to be matched with the expenditure incurred, and because it is a non-current asset which will be realized in the books over its useful life, the government grant recognition should also match the realization of expenditure over the useful life of the asset. Okay, so this is what I recorded on May 1st and May 1st. Now, at December 31st, what should I do? At December 31st, I have to record depreciation, guys, right? So I will say depreciation expense debit, same as here. and then accumulated depreciation credit, same as here. Let me just, okay, same as here. So I'm debiting my depreciation and I'm crediting my accumulated depreciation. But I hope you are identifying the error here. So the depreciation that we calculated here was on the net amount, was on the 9 million amount. But this time we have to calculate depreciation on the total cost of my PP&E, right? So the total cost of my PP&E is 10 million. I will divide it by 10 years. It should be 1 million, and I will prorate it or I'll just do into 8 by 12 into 8 by 12. So this should be my depreciation expense. This. Let me just. Okay, so this should be my depreciation expense. Why? Because in option 2, we are calculating depreciation on the whole cost of the PP&E. But in option 1, we were recording depreciation on the net cost of PP&E, right? So my depreciation expense, I would just delete it, or I just don't want it to be confusing for you. So I'll just multiply 8 by 12, 8 by 12. So it's easy for you to understand. Okay, so depreciation expense here. And now, guys, you know that, okay, for PP&E was my asset, cash was my credited, and then for PP&E, I have recorded my depreciation expense. And now, what about the liability that's sitting in my balance sheet? So now, because I have used my asset for 8 months, I have realized the depreciation expense on my asset for 8 months. Now it's time that I match the depreciation expense with my income as well, right? So my deferred income is sitting at 1 million. Now my job is to recognize the income because here I have incurred expenditure. And now next step is to match income with the expenditure. So now what we are going to do is I'm going to debit my deferred income and I'm going to credit my government grant income. Why debit my deferred income? Because liability is decreasing and my revenue or income is increasing. So I'm crediting it. Okay. So deferred income should be 1 million, or let me just use this 1 million divided by 10 years into 8 by 12, right? Same for here. So 1 million divided by 10 years. Why 10 years, guys? Because useful life of the asset is 10 years. And how many months are we calculating we are recognizing income from is from May to December. So May to December is how many months? 8 months. So it will be into 8 by 12. This is. So now what's happening, guys? So these are the two entries that I've recorded at December 31st. Okay, and now in my statement of profit and loss, I am going to show my depreciation expense. Sorry, first of all, in income statement, we show our income, right? So I'm going to show my government grant income for 66, this much. Don't wanna do it. Okay. And then under my expenses, I will show my depreciation expense. for how much? For this much. And what is the net impact? What is the net impact? That I have depreciation, I have net expense amount of 600,000, right? And here, when I followed option 1, my net expense amount was for 600,000, right? And if I follow option 2, my net expense amount is also same. So the options are two, the ways are different, but the destination is same, right? Whatever my net expense in the financial statements will go, in P&L will go, it will be the net effect of both the options will remain same. So you can follow any one of the option, whichever you think is easier, or if sometimes question mentions you to follow a certain option, so go ahead with that, right? So in my statement of financial position, my asset side would have PP&E cost for 10 million, because we have recorded the gross cost, and then the accumulated depreciation would be this much. So my net book value in on my asset side would be this much, and on the liability side now, my deferred income would be how much? Would be 1 million minus the amount that I have recorded in my statement of profit and loss, this much. This is this much. So the net impact would be, if I just show you here, the net impact is same. You see 8.4 million here, and then you see 8.4 million here. So the net result of following option 1 and option 2 is same. Okay, so this is how you record for your capital grants. I hope this is clear to you now. And now we are going to look at the last part of this section of this IAS 20 is repayment of government grants. Okay, so repayment of government grants. What do you mean when you say repayment of government grants? So sometimes what happens is, if the conditions of the grant is not met, or if they met initially but then they breached, if the conditions of the grant are breached later on, then in some cases grants needs to be repaid, right? And sometimes, if there is obligation to repay the grant and repayment is probable, so we recognize provision as per IAS 37. So IAS 37 and all the information we will be studying in IAS 37 itself, right? But the information that you need for IAS 20, I will be giving you here. Okay? So now, if repayment is for revenue grant and if repayment is for capital grant. So there are two different ways, if repayment is for revenue grant or if it is for capital grant. So if it is for income based grants like revenue grant, then there are two options. That maybe you already have a deferred income account. Like, okay, I'll make it more clear that what if you already received the money in advance and you did not you, don't take it personally, guys, and the company did not meet the conditions, so they have to repay it back. So in that case, if you already received money in advance, right? So it means when you initially recorded advance payment, you would have recorded cash, debit, deferred, income credit, because this is your liability you received in advance, right? Now, when you have a balance already sitting in the deferred income account, right? It could be the full balance, or it could be like you received the money for like 4 years, like $1 lakh, you received it for 4 years, but you only recognize 25,000 in P&L and you have deferred income balance sitting at year end for $75,000. Or it could be that the full amount of money is sitting in the deferred income account, okay? So if you have deferred income account, first debit it and credit cash. For example, if you have to pay $1 lakh, you have to repay $1 lakh to the government. Government paid you $1 lakh, you breached the conditions or you received the money in advance and you did not fulfill the conditions, so you are refunding it back to the government. So you already have 100,000 sitting in the deferred income account. So in this case, if you have to repay, I would debit my already sitting balance to clear it out and I would credit my cash, right? Because I already have a liability account here. Now I'm reducing liability. Why? Because repaid it back to the government and I'm reducing my cash, right? So now, for example, case two is like this is you received $1 lakh in year one, and in year one, year end, you recognized 25% of your 25% of your liability because you met 25% of the conditions, right? So on your end, you recognized it. But when government came for inspecting that, oh, did you meet the conditions or not? And if your conditions did not meet the expectations of the government, then government says, no, I want full 100,000 back. I will not give you 25,000 also because you did not meet our expectation or you did not pass our inspection test or you did not meet our quality test, right? So government is saying that even if you recorded it 25,000, I want it back. So if government is saying it wants it back, then how are you going to record it? Then when at year end you recorded deferred income for 25,000, the balance would be 1 lakh minus 25,000, 75,000 would be your balance. So when repaying back to the government, you would debit your deferred income for the amount of balance you have, right? And you will credit your cash for how much? For $1 lakh because government is saying I want full $1 lakh back. So In that case, you will debit your expense account. Debit your expense account for the balance. Let me just, for the, mm, for the balance, right? So 75,000 got nullified by the deferred income balance. Cash you have to pay 1 lakh. So expense. So you will debit your statement of P&L here. Okay. So if you have already liability sitting in your books, so liability goes to nil. Cash paid 100%. And then the remaining balance would go to P&L as an expense or as a loss, right? It is a loss for you, but it is an expense for you because you recognized income for 25,000, right? Oops, sorry guys, I think I did. Here it should be government grant income account. Yes. So at year end one, you already recognized income for 25,000. And now at year two, when you have to pay at start of year two, then you have your 75,000 balance sitting in the liability account. 25,000, the one that you recognized as income in the previous year, you'll reverse it in the current year. So this will go to your P&L as expense, and then 1 lakh would be your cash. Okay. So for capital grant, it is bit tricky. So just pay good attention to your capital grant question. So if you are reversing any capital grant, and in capital grant, if you followed option 1, that was capital grants deducted from cost of asset, right? So if you followed this option, option 1, that you recorded your asset as a net, net of the grant income. So how are you going to record the repayment? You will increase the cost of the asset with repayment. This is your step 1. Okay. Also increase the accumulated, or also increase the amount of depreciation that should have been charged in the past if no grant was received. And third step is the excess depreciation should be charged and recognized in P&L immediately, right? So now what entries you will be posting. So now I will take this option only. Okay, that in year 1 you recorded the depreciation for 600,000, and in year 2, in the start of year 2, they are saying that we want to we want repayment of the government grant because you breached one of our conditions. So I'm just copy pasting here for your reference. Okay. Okay. So if we were recording the depreciation expense, netting off the amount of government grant income that we received, then we would record depreciation yearly amount of 9 million, but prorated amount of 6 million, 600,000 and 900,000, right? So I have to repay cash. Right? I have to repay cash for $1 million because I have to repay the grant income for $1 million, right? So now I have to increase my PP&E. So I have to increase the PP&E to the amount it should have been provided no grant income was received. Okay, so now let's create another scenario. If no grant was ever received, if no grant was ever received, then what would be the net book value? Then the PPE cost would be 10 million, right? The depreciation amount would be 10 million divided by 10 years into 8 by 12 because we are charging depreciation from May to December 2025, right? So the net book value should be this minus this, right? This should have been my net book value if no grant was ever received. But what is the net book value now? The net book value now is 8.4 million. So the difference in net book value is this minus this. So this is the amount by which my PP&E net book value should increase. Okay, so I have credited my cash for $1 million, right? Now I'm debiting my PP&E here for this much dollars, 933,000, right? So this is the increase in PPE to the amount it should have been that no grant income was ever received. Now the difference, how much is the difference? Difference is this minus this. And what should this difference be? Any guesses? What should this difference be? Now we have seen the difference in the net book value. Now net book value comes from the depreciation, right? If we minus cost minus depreciation, then only we get the net book value. So depreciation expense, if no grant was ever received, should be this much. But depreciation, if grant was received, is how much? Is this much, right? And what is the difference in the depreciation expense? It's this minus this. Oops, guys, sorry, I just keep messing with the plus minus signs. Okay, so the difference in the depreciation expense is this, and this is actually equal to the difference that we are getting here in our journal entry. So what we will do is we will charge our depreciation expense by the difference in the amount of the depreciation, right? So that's what we should be doing. Okay, so that's how we do the repayment of IAS 20 capital grant if option 1 net PPE net option is followed. Okay, guys, I know this is a little bit confusing, but to keep it simple, in a summary, I'm telling you again. First, we see what is the net book value if the grant income is received. Then we see the net book value if no grant income is received, and then we compare it. And when we compare it, we charge the difference to our journal entry, right? So I know that I have to pay $1 million, so I will have to pay it in any cost, but I have to increase my PP&E, right? Why do I have to increase my PP&E? Because I have to bring my PP&E to the amount that should show that, okay, because I'm repaying this grant amount, the PP should reflect the actual cost. So the actual cost will be calculated here. So now, in my statement of financial position, my PP&E cost would be, how much it would be? It would be 10 million minus, or guys, wait, I will show you from my original option to the adjusting entry that we posted. So at December 31st, 2000, year one, my PPE cost was this much, right? And my net book value was, sorry, my accumulated depreciation was this much, right? I'm posting my adjustment entry after posting adjusting entry. My net book value should increase by this much, and then my depreciation expense should increase by this much. Oops, it should be minus, and then this should be 10 million should be the cost that should be representing, and if I show this plus this, and this also equals to this. So it's all matched, right? So it shows that my repayment entry is correct because my net book value matches the net book value it should be after I post my adjustment entry. Okay, I hope this was clear. Repayment is a little bit tricky, but I hope this is clear to you now. Okay, so now moving onward, if option 2 is followed, guys, option 2 is very easy. Option 2, if you remember option 2 is that you recognize everything else in the deferred income, right? You don't net it against the asset. So if you have remaining balance sitting in the depreciation, 1 minute, I just want to quickly check something. Okay, def in the deferred income account, then you debit your deferred income and credit your cash. Okay, so if you have 1 million, okay, let me go here. If you have 1 million sitting in the deferred income, but then, okay, you posted another entry for 66,667 to record your deferred income into your P&L. So, how are you going to do? So, you have a deferred income balance of this much amount, right? And you have to pay 1 million. So, the remaining difference is your expense account. It will be going into your P&L account, and it would be the difference of this minus this. So this was go into your statement of profit and loss account. This would reduce your liability, and this would reduce your cash because you're paying 1 million. Okay. So option 2 is simple. Option 2 is same as the repayment of the revenue grant. So if you have amount sitting in the deferred income, first adjust with it. And if there is additional amount that you have to pay, then it will be your expense going to the P&L. You can call it as repayment expense on government grant or something like that. Okay? So, repayment is clear. I hope this makes sense to you all. And now we are going to study some practice questions. Okay. So on January 1, 2001, Sly received 2 million from local government on the condition that they employ at least 100 staff each year for the next 4 years. Okay, guys. So this example is very similar to the example that I gave you in the initial phase of the class, right? So, mm, let's get started. So Sly has received 2 million of government grant. Okay? And that 2 million of government grant is for employing 100 people each year. Each year, 100 people for 4 years. So, total 400 people into 4 is 400 people. Okay? So, now on this date, it was virtually certain that Sly would meet the requirements. However, on 1st January 2002, next year, due to economic turndown and reduced customer demand, Sly no longer needed to employ 100 staff. The condition of the grant requires full repayment. Okay, guys. So this is something that we just studied. We just studied the repayment of the grant. So how do we record it? Okay. So we have like four options here. These are MCQs, right? So the first option is reduce the deferred income balance by 1.5 million, reduce the deferred income balance by 1.5 million, and reduce and recognize a loss of 500,000, reduce deferred income by 2 million, or reduce deferred income by 2 million and recognize a gain in financials for 500,000, right? So, guys, first thing, you are repaying something. Okay, if you're repaying something, do you think there should be a gain in the financial statements? Very obviously, right? Okay, so now, first step for us to identify is it a revenue grant or capital grant? What do you think it is? Pause the video and think. Is this a revenue grant or is this a capital grant? So, we studied that revenue grant is for meeting certain expenditure that you have to incur each year. So, 2 million of the grant I'm receiving to meet the conditions over the 4 years. But is it for the purchase of any non-current asset? No. It does not say that it is for the purchase of any non-current asset, right? So, no, it is not for the purchase of non-current asset. And because it is not for the purchase of non-current asset, then it is not a capital grant. Okay? So, now, what should we 1 minute, guys. Okay. So now, This is a revenue grant. Okay. So now for revenue grant, what was the entry that they passed initially? When they recorded the amount, they would have passed cash debit on 1st January 2000 X1. They would have posted cash debit and what should be credited. On this date, it was virtually certain that Sly would meet the requirements. So, would meet the requirements, right? So, it was probable, but they did not meet yet, right? So, because they did not meet the requirements yet, so they recognized it as an advance payment, right? So, this was the first journal entry that they posted. And now, on 31st December 2000 X1, they would have met the condition for the first year, right? Now, on December 31st, they would record deferred income debit and my government grant income credit. How much should it be? So, 2 million is for 4 years, right? So, for 1 year, it should be 500,000, right? So at December 31st, because they have completed 1 year and they were virtually certain in 2000 to X1 that they were virtually certain that they would meet the requirements. So at December 31st, they would have recorded 500,000 and 500,000, right? Now, 1 minute. Okay. Now, on 1st January 2000 X2, they are saying, oh, they cannot meet the conditions any more longer. So they would have to repay all the amount at once. So I would credit my cash for $2 million, right? Now, at December 31st, what would be the balance of deferred income? Deferred income balance would be 2 million minus 500,000, remaining 1.5 million, right? Because this was credit, this was debit, so the remaining was 1.5 million, right? Now, I have to pay cash for $2 million. I have balance in my deferred income for 1.5 million. So I will use that first. So I use that first 1.5 million. And because I recognize 500,000 as my income, but it is not an income actually, because next year I have to pay it back, right? So last year I recorded it as my income. This year it will be my expense. So I have to record an expense or loss in my P&L for 500,000 or 0.5 million, right? So this is the entry I will post on repayment. Got it? So let's see what option do we have. Do we have this option? No. No. Do we have this option? Reduce the deferred income by 1.5 and recognize a loss in financial statements? Yes. If you scroll down, deferred income 1.5 million, loss 500,000. So this is the correct option. Is this correct? No. Is this correct? No. We are paying out something. We are repaying something. So how can it be a gain? Not at all. It can never be a gain. Okay. So I hope this question is clear to you. Moving on to the next question. An entity opens a new factory and receives a government grant of 15,000 in respect of capital equipment costing 100,000, right? So for this one, and it depreciates all PN plant and machinery at 20% state line method. So 20% state line method. It means if it is 20% straight line, it would be useful life would be 5 years, right? If I divide anything by 5, it would give me 20%, or you can use 20% as well. Okay, so cost of equipment is 100,000. Government grant is 15,000, right? So we have two options, guys. We can either show it by net or we can show it by gross, right? So which one would you prefer? I would prefer any one because both of them are like simple to do it. But if we go for option one, right? So in option one, we are deducting from asset cost. Okay, so it will be $85,000, 85,000. So I will debit asset 85,000. Okay, and I will credit whatever payment I did for 85,000. And now depreciation I will charge on the net amount. So 85,000 divided by 5 years or 20%. So it will give me around 17,000, right? So in my statement of P&L, my depreciation expense would be 17,000. Okay. And in balance sheet, in statement of financial position, my cost would be 85,000 less accumulated depreciation would be 17,000 and the net book value would be 68,000. Perfect. This is option one. Now, option two, I would record asset, debit, cash, credit, 100,000, 100,000, right? Similarly, I would record cash, debit, deferred income, credit, how much? 15,000, 15,000, right? Now at year end, I would record depreciation on 20% of 100,000. Similarly, I would do recognize income, recognize grant. Similarly, 20% of 15,000, right? So here I will get 3,000. Here I will get 20,000, right? So this is done. Now in statement of P&L, I would show I would show income first, income would be 3,000. And then under expenses, I would show depreciation expense for 20,000, right? So my net would be 17,000. And in balance sheet, I would show cost 1 lakh, accumulated depreciation 20,000, 80,000, and this was on the asset side, and on the liability side, I would show deferred income for 15,000 minus 3,000, that would be 12,000, right? So I hope this is clear to you. This was one of the easiest questions. So you're just presenting it, but I hope the repayment part, which is the most important part, is clear to you. If you have any questions on the repayment part, just let me know. Okay, so now because we are done with IAS 20, I have covered all the areas that should be covered for IAS 20. I would request you to practice questions for this standard from your exam kit. So this week you have to include practice questions from exam kit for this standard. And if there are any doubts, please WhatsApp me. Okay? So thank you so much guys for attending this lecture, and let me know, feel free to contact me if you have any questions. Thank you so much.